The Bureau of Labor Statistics non-farm payroll data has always been a focal point for the market, but this time it triggered collective outrage on Wall Street due to a data mishap. The annual revision of non-farm payroll data showed that job growth over the past year was significantly revised downward by 818,000, marking the largest downward revision in 15 years. However, the market's focus wasn't on the numbers, but on the timing of the data release. Originally scheduled for release at 10 a.m. Eastern Time, the data was delayed by a full 30 minutes. What's more shocking is that during this crucial half-hour, at least 3 investment banks were accused of receiving the data in advance. Among those who obtained the information early was an analyst from BNP Paribas, who stated that they kept refreshing the web page but saw no data. Then, we made a few phone calls to inquire, and they gave us the data. The news caused an uproar, with expletives filling trading floors, while other ordinary investors were left in the dark. The CEO of one investment firm directly vented his anger. The whole thing reeks of incompetence. Why was the data revised downward? The annual benchmark revision of non-farm payroll data is a re-estimation of the annual sample size based on census data. This differs from the monthly non-farm revisions we usually see. It's not a correction of data for a specific month, but a comprehensive calibration of the employment situation for the entire year. The total employment figure in March of each year serves as the statistical benchmark for the new year. The data released by the Bureau of Labor Statistics indicates that the survey overestimated the increase in non-farm payrolls by 818,000 over the past year. The reason for this revision is that economic growth directly impacts the results of sample surveys. When the economy is strong, sample surveys may underestimate the overall situation, leading to an upward revision of the benchmark. Conversely, when the economy is weak, the benchmark is more likely to be revised downward. The downward revision in 2024's benchmark occurred against the backdrop of a weakening economy. As for future outlooks, opinions in the market are divided. On one hand, if the Federal Reserve believes that the weakness in the labor market is only temporary, they may remain in a wait-and-see mode. However, if the data continues to weaken, the likelihood of a rate cut will increase. On the other hand, the data leak incident could undermine investor confidence. If market fairness is called into question, it could lead to a decline in investor confidence, which in turn could affect asset prices. Despite the significant impact of the downward revision and the data mishap, the market reaction was not as volatile as expected. As of now, the yield on the 10-year Treasury note remains at a low level. The market's expectation for a rate cut in September remains at 25 to 50 basis points, with little change. Therefore, the market is still waiting for Powell's upcoming speech at Jackson Hole, which is likely to set the tone for the next phase of interest rate movements.